Okay, so you can all hear me now? Just stick around for 2 minutes. All right, perfect. So I'm Heidy Nolasco. This is Mike Santana, and we're here to teach you all about FHA so we can all tackle it together. Okay, see, it's not over. Okay, so FHA pretty much is, easier qualifying for your customers, right? It's, everybody's talking about it's a shifting market. So we actually what we got to make sure is how can we get more people qualified, right? So this is more options for you guys. FHA is really popular for first-time home buyers, most of the time because it allows them to do 3.5% down. It's the minimum required. Obviously, that's not the only reason why you go FHA. Sometimes a customer might have to go FHA because of the debt to income ratio or whatnot. But that's really pretty much why most people tend to go to it. It's because of the minimum down payment. The credit score requirements also are a lot more lenient with it. We can go at Caliber, we can do all the way down to a 580 score. Okay, but in some instances, I believe there's really no FICO score required for FHA.
So we can close the loan in our name with our normal workflow.
Yeah.
As Caliber, but we can go below 580 through a broker connection.
Yeah.
But it's not as easy as just saying that. Everyone says that, but then there's other requirements for those.
Yeah, so like if you have less than 580 score, right, now your minimum down payment is 10%, right? So if you have that kind of credit score, be ready to put more money into it. They'll do the loan, but it requires more investment from the customer. If you have a 580 or greater, then we can do that minimum down payment at 3.5%. And a 2 to 4 unit with a non-occupying borrower, right? Because that's also tends to be one thing that we utilize is, okay, so you don't qualify, why don't we get a cosigner for you, right? So if that cosigner already has a house, right, and he's not going to be occupying your house, and you yourself need it for that debt to income to qualify, then know that if you're buying a single family, it works. But if you're buying a 2 to 4 unit, they're going to require 25% down. So in this case, if your person that you're using as a cosigner, it's not going to be living in this house, right? Then you're going to have to do the 25% investment.
Real quick.
Yeah, advance the slide so they can see.
Oh, it's funny because the slide is there. I don't know why it's.
Watch, you hit click forward and it'll slowly reveal.
You have to click on the slideshow.
It's got layers.
There you go.
As you're talking about it, you go through and you add the information.
There you
So
go.
what happens with these
I'm
guys?
teaching you FHA, you're teaching me PowerPoint.
So what these guys will do, what they will do is they will immediately ignore you and just read the whole screen like I did. And I just go like this and I can't even hear you, right? So in order to prevent that, so that everybody gets to really learn it and have the full experience, you can, I don't know, I call it layering.
I wasn't looking at it,
Yeah.
so I didn't see that was going on. So thank you for pointing it out, Mike.
Yes, I mean, if you want, you can delegate that part to Mike and he can follow. it.
Yes, can you please make sure the whole thing shows up there?
Sure.
It's gonna be recorded, right?
It is recorded, yes. So you can make fun of me all you want about how.
Yeah, I do have a question. So 2 to 4 unit, can you do FHA?
Yes, you can.
I've always been told you can't do 3.5 down FHA for 2 to 4 units. for some reason.
Yes,
So
you
you
can,
can
as
primary
long
residence?
as you're
Okay.
primary resident.
Okay.
So that's what the key is. It's
Good.
primary resident.
Okay.
And if you do need the help of a cosigner, that cosigner needs to also be occupying this
Yeah.
property, because if they're not, then we need the
25. I think
25.
that's where most people are.
And that's,
A non-occupied co-signer.
Yeah, and this is where, we get hung up, right? Like you just said that, it's not understanding at all. And this is why, this is good because now you get that clarification. So
So if the cosigner doesn't know, if the cosigner occupied, it's 10% down.
no, you can do 3.5%.
If you have a vote.
As long as every single person applying for the loan will be living in that house, it's gonna call that house a primary residence, you can do 3.5%.
And you have to have above 580.
And a 580, so 580 score, And every person in that loan lives, it's going to occupy the house, 3.5% down,
Okay, even 2 to 5.
even 2 to 4.
2 to 4.
Yeah, we, over 5 units, we cannot do. I mean, over 4 units, we cannot do. Yeah.
So what if, you have somebody that qualifies for everything and they find a home, but there's people living in there? They have like, lease for like a year, how can they go about getting that home and still qualifying for FHA if the house is already occupied by tenants?
So that it's something the sellers, if the seller's really interested about, selling, the seller's gonna have to figure out how to, give you at least 1 unit vacant.
Okay.
I can
Yeah.
add that the lawyers for the buyer need to protect their client.
Yeah.
By ensuring that at least one of the units is going to be vacant. I
Yeah,
have one of those right now, with agents in your location here, and that was a concern, that, are any of the units going to be actually vacant? And the lawyers, they work that out together, they have to have one vacant unit, so we can say it's primary.
So let me ask you this, because I heard something about they're now giving 90 days for you to vacate it for FHA, that's not the case. So like you giving notice to the tenant,
so this
but they may not
is,
be out for 90 days after closing, but you still can do that.
so I'm gonna be honest with you, that whole part, we're not even involved in,
Okay.
right?
The lawyers
So
have to.
the
protect
lawyers,
their
so
client.
if there's a separate, and usually I've had incidents where this is gonna happen, and it's usually when you add it to all the riders that I get to see, you added it in somewhere in the contract and you
Yeah.
added it to the rider, then it becomes an issue because I saw it,
I got it.
right? So as long as the contract says you're gonna be occupying this house, whatever gets worked
Yeah.
behind my back, I don't know anything about it.
I've heard that before.
We don't wanna know.
I've heard that from
As
several.
this is being recorded, so there's a lot of things that are being said in a more proper manner than perhaps we would off of video, but
Yeah.
it's all proper and there's no fraud going on, it's just that your attorney as a buyer must ensure that you can occupy the unit, because that's what your intention is.
Yeah.
So, and then we trust them to do that, I mean, we're there holding their hand, and, in this case, I was literally saying, guys, you've gotta do this, but,
No, that happened,
it's
like, I had
primary.
recently that happened where I was like, well, we can't vacate it. They were like, no, you have like, we were told you have 90 days to vacate it based on whatever FHA is now, you can still move in after, you don't have to move in the day of closing.
Yeah.
Yeah, from FHA and Fannie Mae, correct me if I'm wrong, on our end, the occupant, the buyer, they're promising to occupy the property
Within 60
within
days.
60 days,
Yeah.
and
Okay,
for
60.
1 year
Gotcha.
in total. That's what their obligation is.
Yeah, so, and that's where we say, some attorneys don't feel comfortable leaving that out, and then that's when I'm like, then that's on the attorney, there's nothing I can do about it, but you need to be able to occupy this house within
Okay.
60 days.
And the 60-day rule, it messes up some other stuff, like if you're doing use and occupancy, you can't do more than 2 months on paper because we won't allow it, because you can't have a loan.
Yeah.
Are you mentioned the condition of the property?
We're gonna get them.
Yeah.
Yay, we're gonna get them. The,
So let's say you have an FHA loan now,
uh-huh,
right? Like you have a primary residence FHA. Now you wanna move and you want that to be your new primary residence, the 2 to 4 family. What are your options? So you wanna keep the house. In both cases, you wanna keep the house, let's just say that you're occupying now, and you wanna move into the new house and you wanna take advantage of the low down payment.
No, one.
so you can only have one FHA loan,
One FHA.
so, but this is the
That's why,
deal,
like, so what can?
so,
You can refi out of the FHA loan, go conventionally, and then use that, the 2 to 4 as your primary for FHA.
Okay.
yeah,
And in this market where the interest rates are higher, if the person had refinanced before, then it's like,
There you go.
yeah, so, but then also, right, keep in mind, FHA, it's a bucket, right? But there's also, if you already own, let's say, like you said, you already own a house, that's your primary home and it's FHA. If you're buying another house and your intent is to occupy it, you can actually go conventional, 3% down. So you don't necessarily gotta go FHA. FHA, it's just an option for when you don't fit the bucket for conventional, but because that's the other misunderstanding people have. It's that the only low down payment option, it's FHA, that it's not the case.
even for 2 to 4 family, you can do a 3% down on primary and conventional?
So 5% On a 2-family. And 3-family, it's 15%, right? Yeah, 15%. So, the key is,
You shall.
yeah,
Yeah.
but even
Yeah,
like,
yeah.
so for example, like I actually just have a perfect customer for that. If you're gonna go FHA 3.5% down, right, on a 2-family, but then you also have the option to do conventional 5%. FHA, you pay upfront mortgage insurance, so by the time you outweigh the mortgage insurance, right, you're probably better off doing conventional at 5% instead of the 3.5, because when you add those two up, the 3.5% plus the upfront mortgage insurance, it's more likely gonna add up to the 5%. So, you already have the money to do that, why not go conventional? I've always, FHA, it's just an extra bucket where I can fit and have more options for your customer. It's not necessarily gonna be like, oh, now FHA is the only thing we're gonna sell. FHA is just another option we can give your customers, and if that's the best one for them, so that's the one we will use. Like our job is to show you options, and I've always said, 5 customers can come to me today, they're all gonna walk out with a different pre-approval.
Yeah.
Like some might be Smart Series, with 1099, some might be with bank statements, some might be FHA, and then the next ones are gonna be conventional. Every customer situation, it's different. So the key here, or at least what we do, is we show you your options, right? And then what option works best for you as the customer. That's what we'll
In my mind, and this is what I teach all the loan officers, it's like, I have like a flow chart. Hi, nice to meet you. I ascertain whether they're lendable, right? First thing we do is get their credit score.
Mhm.
Then we get their income, and we look at their liabilities, mainly from the credit score, with the proposed new mortgage that they would like to get. Then, are they lendable? Credit score, debt ratio, check, they're lendable. Now, all those clients are going conforming. They're going conventional, Fannie Mae, Freddie Mac, because those loans are, for almost all clients, better. They're going to have, if they have good credit, they're gonna have a lower rate. They still can do the low down payment if they need to, but the idea is that those loans serve them better because the total cost of the loan for them over time is lower. As their down payment and in combination with their credit score starts to get worse and worse, FHA loans start to make more sense because we have more lenient debt ratio guidelines. Interest rate doesn't, you're not as penalized, right? So if you have
And mortgage
2
insurance.
clients, and one has 15% down with an 800 credit score, the other one has 15% down with a 602 credit score. The 602 person may want to consider an FHA because the interest rate penalty is going to be like 0.75% higher than the other client.
And the mortgage insurance would be higher as
And the
well.
mortgage insurance
PMI
is also
costs more monthly for your FHA loans, the worse your credit is, there's like a whole underwriting in there. And then I guess in the end, one other thing to consider is, yes, you're gonna get a lower rate with FHA than a conforming loan for this client, but they also have to consider that the total payment is $180 cheaper for the FHA scenario, but the PMI never goes away. So now, 6 years later, the conforming client is gonna have a payment that's $300 less when their PMI goes away. So do they wanna save $180 every month starting now, or would they rather save more money over time? It's just a decision that the clients each have to make.
client needs
So
to.
you start conforming conventional, and as you get deteriorating situation, you bring in FHA option and you contrast it, right? You have 2 total payments, one may be higher or lower now, but then think about the future, how long are you gonna be in the home? Do you care whether your PMI goes away? You bought a house in 2019, you don't have PMI anymore.
So PMI, that never goes away in FHA?
It does
If
they
you put down 10,
large enough.
if you put down 10% or
payment,
more, then the PMI will go away.
But
My
for almost,
understanding was always 20% and comes off, right?
once you have equity in the future,
Once you have
yes.
equity.
Right,
Yes.
okay.
Right, so anyone that bought in 19, they already have 20% equity.
With FHA is the same way, or FHA you don't, it doesn't come up?
FHA need a much larger down
You
payment.
need
If you put
10% or more.
10% down, so if you ended up in an FHA because your credit score was 600,
Mhm.
right? And you put the 10% down, the PMI will come off. If you ended up doing 3.5% down, your PMI will.
You would have to
not.
refinance.
Even if you get hit 20%.
Yeah, you'd have to refi to get out of the loan.
I'm pretty sure it's outlined in a slide in a few minutes, it's a good question.
Yeah, it
But I
is.
do have one question on the 2-family 5% conventional. that has no ownership, you don't have to live in it, so you can have somebody.
No,
who's not-
no, it is.
Oh, it's still.
Yeah.
Oh, so,
Okay,
yeah,
that's
so,
okay.
you know, let's keep in mind, any low down payment options are only, strictly only for
Right.
owner occupied houses, right? Investment properties, you're gonna make an investment, right? So the bank wants you to have a higher stake on it, right? So depending, it's usually 20% down for a single family. Once you go to like 2, 3, 4 families, we want 25% down. So, yeah.
When you say 10% of PMI will come off, when is that time period? Once you reach your.
Once you hit 78%
Equity in the home.
equity in the home. Yeah. So the other thing, right, so FHA is available, like we said, for the 3 to 4 units, right, lower down payments, but they do impose sufficient guidelines for 3 to 4 families. So on a 2-family and a single family, this does not apply. But if your customer is going into a 3 to 4 unit, that means, you know, we always take 75% of the income. So if the customer is getting $3,500 in rent, that means we only gonna utilize $2,625, which is 75% of the $3,500. Right? But on a 3 to 4 unit, they want the rental income from all units, including the unit the borrower will occupy, it must exceed the fully mortgage payment, right? So we have a perfect example here, right? So let's say that house number 1, full rent roll was $3,500, right? We're gonna utilize $2,625. The principal and interest is $1,375, taxes are $975, the insurance is $110, and the PMI is $211. That monthly payment is $2,671. So in that case, okay, the rent is actually less than that total monthly payment, so we're gonna fail that, right? However, if the rent roll is $4,000, 75% of that, it's $3,000 a month, right? So principal and interest, it all totals up to the same amount, because it's the same house. So 2,671 against the 3,000, it's positive. So even if the 75 ended up totaling, let's say 2,680, this still will pass the test. So, you know, but if it was 2,670, it will fail, even if it's by $1, right?
So a question, so when I have a situation where my rental income is $3,500 and you tell me I fail, can I just get a new lease for $3,600 rent and send it in? Then my rent is $3,600 and it's probably good, right?
Yes, you
I'm
can.
being clever here.
Yes. Yes, you can, but usually, right, so what happens with the thing is, the rentals at the beginning, they're usually based on what's currently happening on that house.
And how do we find that out?
The appraiser is gonna ask the landlord, right? So this is the things where we get creative, right? So usually, I know the things I do when I do a pre-approval is, I speak to your customer, okay, so you can get a 2-family house, where? Passaic. I don't know the Passaic market, right? But you do, because that's your area, that's why you're servicing the customer. I am going to call you and ask you, what are the rents?
Yeah.
Right? So, you know, you're gonna give me that information, so obviously the appraisal's gonna pull comps on rental, always.
Yeah.
Right? But they're also gonna ask if there's any leases, you know, on that for the current owner. If we can prove that the market rent, you know, it could be like the tenants have been there now for 20 years and they pay very cheap rent, right? But if the market rent is higher, then we can make this work.
So you're never going to be able to, what I was getting at is we have to use what comes in on the appraisal.
Yeah,
They use market rent rates, so if you have a situation where your actual leases are really good, you may be penalized, and when you ask them how much rent do you get on this property right now, you know, they may say it's 4,000, but the appraisal may come in and say it's 3,600. You just have to be careful with that.
so, you know, so we always gotta use realistic rents, because I feel like sometimes people just wanna increase it or make it work. The reality is, it's gotta make sense, people.
So let me just say, so on a 3-family, you're living in 1 unit, you're getting 2 rents. You only use the 2 units that are being rented, not the unit you're living in.
Right.
Okay,
You can't use a unit that you're.
No.
No, because that's why it's owner occupied.
So what happens in the situation of Mike said, you have above market rates, can you, if you prove it goes into your bank account, can you do anything like that, or is it just?
Well, you're asking the seller to give you their documents to prove that.
Yeah.
I don't think there was ever any way to get away with that. No.
Yeah.
You're limited by the appraisal.
Mhm, you really
It
are.
helps when the rents are low,
Yeah.
and if the rents are high, then it hurts, but I think that the appraisals are usually, they don't really cause me a lot of problems.
Yeah, I've not seen
They
many.
I haven't
kinda-
had one.
They kind of give you what you're looking for, and that speaks to an entirely different topic about who's doing your appraisals.
Yeah.
So just suffice it to say that we have a very good relationship with almost everyone that's going to be doing their appraisals. As long as you're in.
As long as it's a realistic information, right,
Geographically proximate to where,
we
we've
can
been
make it
working.
work, yeah.
so we have an appraiser panel, several appraisers, many appraisers. And they are instructed to go back to their appraisal management company if they anticipate there being any problems. So good communication with your loan officer is essential when you worry about an issue. You guys say market rent's gonna be about this, and then we have the appraisal that we're waiting on. Perhaps when we order the appraisal, we send a document that you guys provide that indicates, wow, rents should be about this. Just like we give them a copy of the contract of sale. Every appraiser is not trying to hurt us, they're trying
They
to
really
match
are
the
not.
contract of sale, so everyone's happy. Sometimes they can't, and that's when you get an advanced warning, rental contract.
All right, so next slide, there is different kinds of FHA programs, okay, you should utilize for different things, so your standard FHA, 203B, it's, you're buying just a regular home and you're gonna move in there. The next one, it's the 203K, that's a renovation loan. So that's usually renovation loans, it's when you don't have CO, there's a lot of work to be done on that house, it's non-functional, right? So a lot of the times you'll see listings that say, like buyer's responsible for CO. That's the one instance where you can use FHA 203K because, it allows you to fix the problem after you close on the house.
So with that one, you can't do like a complete, like, demo and rebuild, you have to have a certain percentage of the original homes. That's what I was told.
Yeah, so that's reno, so that's not construction, that's why it's called renovation program,
Yeah, yeah.
right?
that's
So
what I'm
gutting
saying.
out, that's new construction, reno is you're gonna renovate, it's
So
an
how much
existing.
of, like, just keep everything, because I was told like you can still qualify for renovation as long as you keep like 25% of the original structure of the home.
Well, yes, I guess if you're trying to get super creative like that, yes, you can use a rental loan, renovation, it's that. You gotta keep a certain percent of the original
A
structure.
lot of
And
people do
then
that as
renovate.
well, because they need to keep a certain amount, so you're not considered a new home.
Yeah.
So
Yeah.
they keep the taxes down, so I think it's like
Yeah.
10% of the home or 20% of the
I
home.
think the phrase is down to the studs.
Right.
The bottom line is each unit, each property is unique. So I was on a call 2 nights ago with the client,
Yeah.
the contractor failed on the project in the middle of it, he's the owner, and he just ran out of money. So it's like, the outside looks pretty nice, but it's still plumbing and stuff like that, and inside, a lot of work, 200 grand at least.
Yep.
What you do is you get the contractor to give us an estimate of what needs to be done. So we have what we call schedule of repairs. And then we send that to our HUD consultant or our renovation review people. And literally, the other night, I got a call from the client. Her father is asking me about, well, can we do this? Is this property eligible for renovation loan? And I just got the HUD consultant on the line. He's going to be in your market center. We were talking about it on what's that application called?
What's that?
It's on WhatsApp. Giving away my age. But on WhatsApp, someone asked a question, I think it was Nara, you asked a question about basements and what kind of heating systems or something, remember that? And we've got the guy, he's gonna come, I think they scheduled it for like the 14th.
Yeah.
So they're gonna be talking about that, I call him, he answers the phone, 7 o'clock at night, and listens to the guy's description of the property, and tells me, yeah, we can do that. So you gotta go case by case.
Yeah, so renovation really is case by case. Sometimes it might be something minimum, sometimes it might be a big project.
What's the streamline limit now? So like keeping it on the streamline, or keeping it on the HUD's contractor?
That's
Okay,
30,000,
sorry.
right, Mike?
35?
Oh, because I know it was like
Yeah,
1.29, that's all I want to know. what's
Yeah,
the
no,
limit on it.
it's
So, we're
35.
at 35 now?
I'm gonna lose a lot.
I'm gonna guess 35 and I'm just
Yeah,
get back to you.
okay,
Okay.
yeah.
What's that? 35,000 is what,
So, you know, it's not, so if you go over the 35,000, you gotta get a home inspector. So there's like a limited rental,
35.
it's 35, right? Yeah, so if the constructions, it is 35, Mike? Oh, okay, so, I thought it was 30, it is 35, okay, that was 35. So if it's only gonna cost $10,000, you know, it might be something as one bathroom's not working, right? So this is why we need, every house is different, right? So if you only need $10,000 in work, you know, it's actually a lot easier to get done, you don't need to bring the HUD inspector in, you know, you do the work, you know, but if it's gonna be over 35,000, then it's a little bit more extensive inspections on our end, you know, that we gotta do, you know, for us to be able to do that,
So, can I ask a question about the FHA, and I don't wanna go too off track.
And hold on, and I'm also, I don't wanna get too much into renovation loans, because I'm actually hosting a specific class on renovation loans where I am gonna bring you a HUD inspector, and I am gonna bring you a contractor that specializes in renovation loans, okay? So that way you can see how easy and, you know, streamlining, like right now, I guess, you know, everybody's talking about inventory, right? Well, with this program, with rental loans, we actually can create inventory for our customers, right? So that's gonna be the next class. So I don't wanna give up too much, because, you know, I'm not a HUD inspector, and neither am I the person that does the renovations. So I want them to be here to answer your questions, to when I do that class.
So the guy that's coming is Peter Lustig, and he will literally survey your market individually, if you want to work with it, and give you a list every month of homes that are great renovation candidates. It's a good lead generation.
And then the other FHA type is disaster relief programs, right? That comes in handy, like what just happened in Florida, right? A lot of people lost their homes, they need to find a new home, right? So, you know, that's what we can help them with the disaster. So as long as their current home, it's a total loss per FEMA, then, you know, we can get them into a, you know, new mortgage with FHA. You know, this program provides victims of presidentially declared major disaster areas the ability to get a mortgage and become homeowners and just restart from ground up. The next one is allowing your borrowers to qualify for more, right? So I explain, you come in, I give you options, right? So I'm gonna say maybe conventional, your budget, we're maxed out at 400,000. You're like, Heidi, with this house that I really love, we get 600. And taxes are $3,000 higher, right? So this is, you know, where your customer also has the ability to go FHA. Maybe they got the 800 credit score, right? So it's not necessarily because of the credit. It's got to do because, you know, their debt to income ratio does not allow them to get into the house they really, really want, right? So, you know, we're able to just kind of save the deal. Yes, you can get this house, we can go FHA. Ultimately, it shouldn't be an issue to the seller because, you know, you're getting 625. Do you care how he got to 625? When you're getting 625?
But they
Right.
do, that's the problem.
No, but I mean, I'll be honest
saying,
with
but
you,
that's what I
it
was
takes
saying.
us,
Yeah.
it takes you listing agents to
No.
educate your customers, because I'm gonna be honest with you. That trend of teaching,
Yeah.
do you think your sellers know the difference between FHA and conventional? They got no clue. You know who told who told that seller about the difference?
Yes, right.
You did. So it is your job to educate that seller and say, you know, listen, they're offering you 600 and this guy's offering you 625. Like, you're getting more money. Like, what is it? You know, listing agents created that. So it is our jobs to educate the sellers. You know, you want to, ultimately you want to sell your home, right? So your house can sit here because this is the market that's gonna come. The shift market, what it means is houses are gonna sit a little longer.
I think most sellers, like, I know I always try to do it, but when you're on the buyer's side, sometimes it's hard to get the listing to do it.
Yes,
I think a lot of sellers are worried about FHA inspectors coming in and nitpicking stuff, but I'm like, if you make it 30 grand more and they ask you to paint the side of your house, paint the side of your house.
Yeah, you can go get
It's
a
like,
$20
But even
gallon paint,
depending
you
on,
do it.
some buyers are willing to do it if they know they're investing, because I do insurance sales, I'm like, listen, you have to do the work if you wanna make FHA happen, the seller's not doing it.
yep.
And some buyers will do it, they're like, I
Yes.
want the house.
I
So it's
was
about
gonna
really-
say, I have a buyer who just prepped that house for an FHA appraisal last weekend.
I had the same thing, I just closed on a, I just
So-
closed on a loan last month, it was the same thing. The guy literally went to the house and did the work himself, because he was
Yeah,
not.
no, I one that mowed basement, completely mowed it out, I was like, you gotta rip everything out, they were like, not a problem, like,
Yep.
it's on you, so
Yeah.
I'm not doing a thing, so they ripped them sheet rock out, what a great thing.
You know,
Yeah.
so, this market really is about getting creative and making sure we're gonna get people into houses, and, they don't know any better. We do, we can teach them, right? So, so back to ratios, conventional, it allows us to do 45 front ratio, so front ratio means housing, right? Mortgage, taxes, insurance, and mortgage insurance, if there's any, that is the front ratios. Back end ratio is mortgage, taxes, insurance, plus the rest of the debt you got, car payments, car loans, credit cards, student loans, anything that appears on your credit report, that is, your back end ratio. So conventional, we can do 45 compensating factors, it lets us do back end at 50, right? So 45 front, up to 50 back end ratio. FHA, as you can see, it's a lot more flexible, right? So, I gave you that example, the customer that, if we can make it go to like the 600,000, where now the debt to income ratio is at 55, but he's got those excellent credit scores and he's got 15% to put down, right? But he wants this house. Well, the only way to get that house, it's FHA, and, because I can do it with the higher debt to income ratio, right?
Another thing with FHA with student loans, I know a lot of people my age, 35, 36, 37, we're still paying off loans.
Absolutely.
So, FHA, they count a 0.5% instead of a full percent. So that makes a huge difference in your
Yeah.
buying power with your debt to income.
Yeah.
I run into that a lot with my friends, people my age that, I still have student loans as well. So, it's a big deal. It comes off, you can save a lot of money and knock it off from your debt to income ratio by doing FHA as well.
Hey,
So let's say you did have a big loan where you paid it, but it hasn't really affected your credit score yet. Would you guys take that into consideration?
well, that's what's good. You must have missed my credit repair class. So we actually have the software. When I pulled your credit, right? The system's gonna tell me if there is ways to improve your credit score. So with that, even if you did it, then great, because it's just a matter of me placing the order, update this balance. But if you haven't even done it, I have the way to tell you, we can increase your credit score by 40 points, 60 points, whatever it is we needed to increase, if you do this and that and that. I give you a list of things to do, and if you follow them and you do them, I will get your credit score up within a week. So,
There are some loan programs where if you have a bill that affects your debt ratio too much, we can have you pay it off. You may already have paid it. If you can prove you paid it prior to the application, in every case, we can get it omitted from the debt ratio. And even many loan programs, including FHA, even if you pay it after we pull your credit, you instruct you to pay these 3 things in order to qualify.
Yeah.
So yeah, we can help you to,
You pay at closing too, right? Sometimes they allow it, or
yeah,
it becomes tricky.
it can be paid, no, it can be paid at closing.
Okay.
As long as we get a payoff from the vendor, so
Right.
this is the full payment. Sometimes when you do it that way, they make you close the account.
Yeah,
and this
No,
is,
just
no,
pay
they
the
don't,
bill.
that's only on car loans.
Yeah.
But on credit cards, they don't make it close,
So,
because I do it all the time.
so how does that affect your credit score if it's done at closing?
It doesn't affect it, and I'll give you an example, right? I actually have a customer who came in, and he's actually putting 40% down payment on $1,100,000 house, but he's self-employed. I review the taxes, debt to income ratio, it's way too high, right? He's got this car payment, $1,000 a month, right? So that car payment, it's making all the difference in the world on my debt to income ratio. So I said to him, you owe 50,000 on this loan, but you're putting $400,000 down. So I'm like, the deal works if we pay off your car at closing and you only have to put $350,000 down. So actually now you start no car payment, right? That only works if you are financing the car. It does not work on leases. So leases, you don't own the car. And when you're done with that lease, we have to assume you're gonna get a new lease. Because you gotta drive something to be able to get to work. So it only works, when it comes to if you're financing the car and you're owning it. So we do get creative also on how to make the ratios work, but then obviously the customer has to have the cash to be able to pay that debt down, right? I have customers that the ratios are over 50 and I'm like, but if we pay this at closing, you'll be fine. Okay, that's fine. So now you on top of your closing costs and on top of your down payment, you need to come up with the rest of the money to pay off this debt so we can make the deal work. So
You said you have this as a file, you can send us the actual paperwork here.
it's gonna be recorded, and
No.
yes, I can send it to you, honey,
Yeah.
all day long, yes. And remember, he's here, I'm here, don't be shy, we don't bite. You can call me, okay? Some of you have called me and, it's, free knowledge, I'm happy to give it to you, okay? Then we're gonna get into the insurance premiums, right? We talked about this a little bit before, right? So in some instances, you don't, your mortgage insurance, the from mortgage insurance is gonna be higher. In some instances, your monthly mortgage insurance is gonna be higher. It all depends on the situation and the customer. Every customer is different. So based on loan amounts that are under 625 and under 95 LTV, the annual mortgage insurance is 80 bips of that loan amount, right? So it's, in this case, will be if it's a $625,000 mortgage, times 0.80%. Right, so that's how we calculate the mortgage insurance. So mortgage insurance, it's different for every single customer. It all depends because it has a lot of variances. It also, some of them drop, we talked about it before, right? So if you put 10%, if you put less than 10% down, you're gonna pay mortgage insurance every month for the life of the loan. If you put 20% down, you're gonna pay it for 11 years, right? So it estimates that it takes about 11 years to get down to that, 78% market. The higher the down payment is on FHA, your mortgage insurance can come off. But the minimum down payments, those you will pay the mortgage insurance for the life of the loan. So the monthly mortgage insurance, I know we spoke a little bit about it earlier too. We got into the subject, can be cheaper. It all depends on the situation, right? So we gave you two scenarios here. A customer with a 680 credit score, okay, conventional, putting 5% down with the rate at 7.625. The monthly MI, it's $275, right? If you put that same customer, same scenario, right? The rate is cheaper, FHA, because FHA tends to have cheaper rates. But that mortgage insurance, if you look at it, it's $339, which is, higher, but then you gotta compare total monthly payments. And I know that right now, everybody's working on budgets, right? So, on this specific customer, what's a better option, right? FHA is actually giving a cheaper total monthly payment, okay? And then we go back and we compare scenario number 2 at the bottom, right? 660 credit score, same purchase price. You can see the rate is also higher on conventional because they're given the same rate as the 680 score, but you gotta pay points to get that. So that customer is paying have a point fee to get that rate, as opposed to, you know, the FHA at 7.125. And in this case, the mortgage insurance gets a lot more expensive on conventional because of the credit score, right? So FHA doesn't penalize you as much for that credit score. So, you know, look at the difference in payment. 37.66 as opposed to 39, you know, 88. So, you know, it comes down to the customer. So, you know, again, you know, the fact that your customer went on an FHA mortgage, you know, it's because it was a better scenario for them, not necessarily because it's a horrible customer.
I get a lot of clients ask, well, I need my monthly payment to be X. So like I'll sit down with them and I'll do pretty much this. And I say we can go two options, conventional FHA, and conventionally you're at 3,900, 3,988, FHA, you're at 3,766. You want your payment to be around $3,700, well, there you go.
Like we said earlier, it's brings home that point we were discussing. So you can say to the client, well, you can have your payment 37.66, but that's going to be until you sell the house or until you refinance it out of an FHA loan. Whereas you can be 39.88 for, what do we say, 11 years? It's, you know, it depends on the market. But then all of a sudden, now it's going to be 34.30 when the PMI falls off. So do you want to pay more for 11 years and less later? You just have to give them the options.
So,
FHA, no.
yes, so this is the best thing. I know all of you want to know. So I printed it. I want you to have it, take a picture, right? So when we're doing this listings appointments, it's important that you listing agents know this, because this is how easy it is to just be able to find more buyers for your property, right? FHA does not require cosmetic or minor defects, you know, or deferred maintenance and normal wear and tear. They don't require for all of that to be fixed. But this is the big no-nos, okay? So missing handrails. Had a house, 2-family. The unit, the second floor unit actually had access to the attic, which they had it into like a big playroom, right? Well, those stairs didn't have a rail. So all it was, and my buyer did it, the seller didn't do it, but my buyer went and did it. They put stair rails and that's it. We passed inspection, we passed, and we did it 1, 2, 3. We just had to go back, take pictures, it was done. You know, cracked or damaged exit doors that are otherwise operable, right? So, you know, I don't know, maybe the exit door, you had an angry teenager punch the door and now there's like a little crack because he punched the door, but it's, you know, they're gonna want that door to be replaced. I mean, you know, how easy it is to repair that, right? DIY, there's YouTube for that, right? Let's get creative. Cracked windows, right? So all the windows gotta be good, you know, it can't be no cracked windows. Defective paint surfaces, so the paint cannot be peeling, you know, so minor plumbing leaks. So there'll be times, you know, we'll have like, you know, the toilet that just keeps on running, right? I mean, I think the kit to fix that, it take $250 at home.
Yeah.
I'm just saying, like.
And I can do that for you.
It's, you know,
That's all I was
and there you go, and we got Mike, if you see this, it's such an easy fix, guys, it's not as bad as you think. Defective floor finishes or coverings worn throughout, you know, badly soiled carpeting. You know, evidence of wood destroying insect or, you know, evidence of unrepaired structural damage, rotten or worn out countertops, damaged plaster, sheetrock or walls, ceiling materials, poor workmanship, right? So I once saw a person get very creative because they didn't have a laundry room. Okay, so they had a closet, and decided to put the laundry room in that closet. And they opened up a hole and for the washer, you know, instead of doing the plumbing and properly running the plumbing, they just opened up a hole and did the extension hose and, you know, now that water dips into the sink. Listen, it worked, right? But same thing, you know, that's not a lot of work to do. It's something you could have easily gotten done. People just want to get creative and sometimes it's just, you know, yeah, trip hazards, you know, cracked or partially heavy sidewalks, poorly installed carpeting, you know, crawl spaces with debris, you know, like trash. It's really just doing a cleanup. Like when you do a listing presentation or walkthrough, you know, these are easy things to do. Like, you know, and like I said, we gotta create more customers for these sellers. Like I know we still, you know, we still seeing a lot of activities, but you know, when it changes, this is getting creative and how we're gonna bring more buyers to those sellers, right? And if they know it up front, the biggest thing is, if they know these little things up front, and you really wanna sell, how many people will just do it? Right, so, this is gold. Save it on your phones, you need it on your listing presentations. You know, on FHA, we can do both we can do all single families, 2 unit, 3, 4 units, and we can also do condos and townhouses, right? And when it comes to condos, the building needs to be FHA approved, but we do have a way to do single unit approvals, right? So Mike, can you touch on that? I know
Yeah.
they told me that you're an expert on that one.
So we just got one this week, 18-unit condo in Cresco. You know the monument there by Cresco, it's in a circle? Yeah. Right on the corner there, I guess it would be the southwest corner, is an 18-unit condo development. I can't even remember the name of it. But they are not FHA approved. We went in and we educated them about how getting FHA approved would enable more people to qualify to buy units, which makes them more marketable, which helps the values. They understood that, and I worked with this 80-something-year-old lady named Gloria, who literally didn't even have a condo budget for her 18-unit condo, that she's one of their owners. They just kind of winged. So they are insured, nobody's suing anybody. Most of them are owner occupant. So we don't have all these things that typically mess up condominiums.
Yeah.
Or townhomes. But they just literally financially were just kind of getting the bill, and paying the bill, and getting the bill, and paying the bill. So we asked them for their records over the last 2 years. And I went through and analyzed them, and I created their budget. I typed it on a spreadsheet, sent it over to her. She made some changes because it's not perfect. She wanted everything to be accurate and true. And her budget, and sure enough, they have enough money in reserves, and they have all the things necessary to be approvable. But they never bothered to do it. So we have one client, she's buying a home with a Keller agent, Anna Anderson. I don't remember which market center she's in. She might be with Tenafly. Yeah. So Anna's client is going to buy one of these units, and we approve them for their loan. At the same time, we approve the condo for the FHA as a single unit or a spot HUD. And now this loan will close with an FHA loan, and I'll go to the homeowners association meeting next month with Anna. And now who's going to be their favorite realtor and their favorite lender? You know, everyone that lives there is going to be made aware of the fact that we made their places, you know, more marketable, theoretically improving the value of both. So it's a really good, another good lead generation tool for you guys is find a smaller FHA, not an FHA approved place, and you can just Google it and say, what is it? It's at HUD.gov, but you just Google FHA approved condo list, and you'll be taken right to the website where you can see all the condos and who's not approved FHA. Mainly they're not approved.
I was gonna say, the list is
Yeah.
so small.
Yeah.
And I'll be honest with you, you know, it also just takes a little bit of homework on your end for us to be able to tell you, yes, we can get them approved, or no, we cannot get them approved, right? Like, why close that window and just assume, you know, we cannot do it? It's us. All it takes is really all the information we need. It's in that condo questionnaire. Most condo associations, like the management company, already has a general condo questionnaire. You hand that over to us, Heidi, this is the kind of questionnaire, can we get, you know, I know my customer is only FHA approved, can we get FHA approved? We send that condo, they'll be able to tell us yes or no, like as long as, you know, everything we need to know, like the max units, because like how many units are owner occupied, how many units are investor, all the information we need to know, it's in that questionnaire. So we don't even have to go back and forth. It's a simple question as going to the association, can I please have a copy of your condo questionnaire? And with that condo questionnaire, we can tell you if we can make it lendable or not.
How long is that process?
It depends on their cooperation, the ability to provide the documents, right? So
Yeah.
Gloria took us over 3 weeks because she's 86, and when I call her, she gets back to me the next day. When I email her, she says, what's an email? So I literally had to drive her. An old girl, I was like, "Hey," she handed me this spiral bound 3-inch thick thing that they created in like the 70s. And that was their bylaws and their master deed. Because the file that they had been, I don't know why I'm standing there so fast. The file that they had been sharing with everyone for the last 25 years, when they were being asked for these documents, it literally was missing like 40 pages. It had pages out of order. There was, I remember page 12, page 16, pages 20 through 28, they just weren't there. Nobody knew, and none of the lenders even considered lending on these places over the years. No one even realized it. So we figured out there was missing pages, talked to everyone. No one had a PDF of it, so I went there, I got the thing. It was like, you know how walls in old places are all smoke stained, cigarettes? It was that color. From like the guy smoking in the place that owned, you know. So I take it, I go to Tenafly, I rip out the plastic thing and I scan the whole thing. And then I go to Kinko's to put another one of those, or not Kinko's, Staples, they put one of those things back in. And I brought it back to her the same day, and she was just like, she thought it was like this treasure. She was so worried I was gonna like run away with it. If I lose that, they don't have the time.
Yeah.
But that was the key to getting it. We got the budget, which she signed, and we got the actual, all the pages for all the documents. And, yeah, they're closing, like on the 15th. So if you're thinking about ways to build your business, you can just forget everything if you want. You can forget everything you've learned already and just pick this one idea and just run with this. And go and sit with homeowners associations in their monthly meetings, ask to come, you know, bring whatever, what do the people want? You know, they want something, snacks, if it's in the morning, it's bagels, if it's in the evening, it's whatever, salad. And you go and you explain, educate them about this process. You could literally become the FHA condo guru. You could, there's so many condos.
Yeah.
Just focus on one thing.
Yeah, so if anything, you know, I guess
We'll go
this
with
is just ways to just expand your business, right?
Is mixed use, one of the qualifying properties?
So we could, FHA, we could do mixed use, however, the living space percentage, it's crucial, right? Because it cannot be 51% of it has to be residential, right? So when it comes to a mixed use property, we kind of need to know square footage, like what percentage of that square footage is, you know, commercial and what percentage of that square footage is residential. But yes, there is times where you get, let's say, a 3-family house, I mean, a 3-floor place, right? And it's a business, like an accountant's office at the first floor, and then you're gonna occupy the 1 floor, and then the 3rd floor, you're gonna rent. So you could do those FHA as well, but the key comes down to the square footage, so that's important, you know. But usually the listing agent will have all that information, you know, ready to give to you guys.
You said it's 51%.
51% has to be residential. You know, so like the common areas can help you to get there, right, Mike? So let's say it's an accountant's office and an apartment upstairs, right? That's kind of 50-50, right? But then the common areas, it's, you know, the stairs can make it for 51%. So, you know. Yeah.
Usually if it's on paper layout exactly the same, then it'll work.
Mhm.
It's just when you have a larger downstairs, and so many businesses.
Yeah, then it's a little bit of an issue, so, townhouses, you know, these are a little tricky because some people think they're buying a townhouse. Sometimes townhouses and condos will look the same. You know, so it's important for the customer, what kind of property. So, you know, when you buy a condo, you're personally on that individual unit, right? The townhouse, it's more a single family that's just attached to another unit. Like all the common areas of the condo are owned by the association. You only own that specific unit. So that's important to know. I guess now I get to open it up for questions for you guys. So I asked a lot of questions, but if you have any other questions?
Can we have these copies?
Say that again.
Can we have these copies that you have?
100%. I'm gonna email it. How about this? I'll text it on the WhatsApp, and I'm also gonna have Amanda email it to
Yes, please.
everybody, so you guys have this, and then, you know, feel free. You have customers that have questions. We don't charge to sit down with your customers or to have a consultation. It's free. So, you know, the best thing is right now, like I said, it's, you know, educating your customers. Do you have a question? Were you raising your hand? Oh, okay.
So how is your credit score affected after you apply for one of these loans?
So-
How much does it drop?
Actually, for the purpose of a mortgage, it does not
It
drop
really
your
does, it
credit.
really doesn't.
It drops your credit score. If I pull your credit score, I pulled your credit today because you are interested in buying a home. And then customers do this all the time. They go to Macy's on the weekend.
They open up 2 credit cards.
And they say, well, you know, you can get 25% on your purchase today of $25 if you apply for this credit card. And everybody seems to think that 20% is so awesome and they apply for it. That means you're shopping around for credit, but for the purpose of a mortgage, it does not drop your credit score. It's only when you're running it for something else, then the second time that it'll affect it. But for a mortgage,
A follow-up question to that,
Yep.
because if you don't purchase within a certain time frame, then it does affect it, right? Like if you don't end up purchasing.
no, because even, so usually credit, when we pull credit, every pre-approval, it's good for 4 months,
Right.
right? That is if nothing changed, right? So I pulled your credit, that was, you know, you got the 800 score, I gave you your pre-approval, you didn't find the house, in 4 months, you're gonna say, oh, Heidi, this letter's expired, right? I'm gonna have to run your credit, but it's a mortgage purpose, like, it's not going to go down. But if you went to Macy's that weekend before, and I'm very good at telling our customers, because I know I do it, and even Jane, our assistant, when she sends the email that, you've officially been underwriting approved, the main thing it says that, do not apply for new credit,
Don't
do
go buy a new
not,
car.
and listen, and life happens, and if you do
It's
have
happened
to,
to me,
because
and
of
then they don't qualify.
you have to do it, call me. I had a customer who called me because he got into a car accident and his car was total loss, right? But we're in the middle of purchasing a home, like, Heidi, what do I do? You gotta buy a car, dude. You gotta buy a car. So my thing was, what's your monthly car payment? Your monthly car payment is, $450. Your car payment cannot be more than $450, and it's not going to affect you,
The
right?
clients call and they say, I need to do this, and you say, okay, what would be, you can do that monthly payment for your,
Yeah,
you need to borrow your money down payment from your FHA, from your 401k. Well, what's the monthly payment going to be? Well, add that to your debt ratio. you're
Yeah.
good. Or you're not good.
so key here is communication.
Yeah.
Is key between that customer. And trust me, sometimes, no matter what I say, they just don't
They
get
just
it.
do it anyway, and then you,
So don't do nothing, don't put no money in the credit card, don't do anything.
what do you mean, I
Next
can't
thing you
do
know,
it?
it's like, oh, I ran up $500, did I not tell you, don't do anything?
Yeah.
I tell them, like, when you have the key
Then,
in your hands, dude, you
Yeah,
can
do whatever you want.
anything. You wanna get into debt, you wanna go get a
That's what I
porch,
said, the day closed.
be my guest,
Yeah.
celebrate your home ownership.
I always
You
tell
can do
clients
it
that.
till that key is actually in your hands. So,
Yep.
What you wanna do?
Here's the keys, clear to close, see you later.
yeah.
On the self-sufficiency test, it says 75%.
Yeah, that's it.
So for a single family.
That doesn't apply, yeah, it don't matter, yeah.
Well, we don't
As
have to
long
do-
as the
we don't have to
customer
do the
qualified, right?
self-sufficiency Test for 1 and 2 unit homes, but we do always take 75% of rental income. That's
And
how
use it
we
as
calculate.
additional.
Yeah,
There's like a vacancy factor, and they just put 25%, meaning that over time, you're gonna have changing tenants and you'll have a place vacant for 25% of the time. They're being conservative to make sure that you don't get yourself in over your heads making the payment, right? It's just the worst thing that happens, all of a sudden you can't find a tenant. So yeah, we take 75% of gross rent for all the income calculations for all the ones. That's just universal.
yeah.
But then the self-sufficiency test is not required.
And also, you know, I know we did this class because we want you to know, but I don't expect you to be able to have conversations with your customers and have it all. So if something arises, just say, you know what, why don't you call this person?
That's
So-
a huge point that I really think we
Yeah.
should make almost every time we present.
Yeah.
We can practice. Repeat after me. What's the client's name? Susan. Repeat after me. That's a great question, Susan.
It's a great question.
I'm glad you asked. I know a little bit about that. All I know is that Heidi knows everything about that. So I'm gonna introduce you to Heidi Nolasco right now. Conference her in. Heidi will take over.
Yeah, because you know, like, what's the name of the game? Like I tell you, I whisper something on your ear, by the time you told me,
Telephone game.
the story's completely different, right? So, you know, and again, every customer has a story. And every story is different. So, you know, so the answer you're gonna give one customer, it's not gonna be the answer that other customers going to get. So, you know.
Last night I was telling one agent about an issue with condo warrantability. So if there's 75 units and 62 of them are rental units, it's very difficult to get a conforming mortgage on those because they don't pass the condo questionnaire. So anyway, the question comes in about this one place, and it's from an agent through another agent to me. I answer him, and he goes back to her, and they go back to the client. And it was like telephone. I had to get on the phone with the client and re-explain it.
And if you kind of like give like information that's not covered, you're liable or not?
You as the agent?
Yeah.
You as the
I'm kinda
agent?
like, no,
Well,
I
you
don't
know-
wanna give you advice because I'm not a professional on this, I just call this person or
Yeah,
email
yeah.
this person.
Yeah, and that's a
That way
good
I
thing,
feel
right? Because you
comfortable.
really don't want to get anybody mad,
Yeah.
because sometimes by trying to answer, you know, questions, like perfect example, when I do those pre-approvals, I do not assume what kind of rent I can use. Because if I knew the rent in all New Jersey market, holy shoot, I wish I was that smart, you know, I call you guys, you know, so your customer, where is he buying? What do you think that those taxes are? What do you think that rent is? I never assume, because I don't know, you know, I only know where I live, right? Because you only know what you do on daily basis, so, you know, so use the same thing, you know. I
Most
never-
people tend to remember like, oh yeah, so and so told me this, and they pass in the wrong information, and
Yeah.
next thing you know, you're like 20 people know the wrong
No.
information, they can bail them out.
Do you guys work with people with tax ID?
Yes, we do. And what's important to know with those programs is that they are available, but you do have to put 20% down.
20, that's. the
That's it. No if, buts,
20.
it don't matter. 20%. You got 20%, and I got news for you, most of them have.
The same logic applies to any mortgage. The lender needs some type of security that you're not just going to run away and leave the keys in the mailbox. When, let's say the real estate market goes down 10% next year, it's going to, but whatever, it did in 2008, right? So now all of a sudden, you've just given someone who conceivably could just leave the country, literally. And now the house is not worth as much as you lent them. So the lenders would be out. So that's why there's 20%. It's like, that's why
And we
PMI is
really-
required. Because the lender needs a security that they're not gonna lose their investment. Because when not you, but when anyone abandons a home or doesn't pay the mortgage, they take possession of it and they're just gonna lose more money.
Yeah,
Only
I
to
was
not get
just
paid
gonna
the
say,
mortgage
we're
for
not
2 or
in the
3 years.
business of taking houses away from people. When, you know, banks, when they give out the investment to give you a mortgage, it's with the intention that you're gonna pay off that house and you're gonna keep it, right? So, you know, it's a higher risk. So, you know, that's why it's more down payment, but we do.
All of these things are done to protect the consumer. Think about those list of FHA repairs that might be necessary. That's because they're trying to make sure that people buying these homes aren't being shoved into a situation where they're just being screwed, you know, think about it, you're in Florida, there's no lawyers. You know, you got a realtor on the buy side, he's dual agent, and they're recommending an inspector to you. I mean, you're on your own out there,
Yeah.
not here in New Jersey, you're protected very well by attorneys, but it's a big country.
Yeah.
So think about it.
So a person's immigration status doesn't really affect them. Loans.
As long as you have either a work permit, right? Because
Or a
if you,
backup person.
yeah, they can buy, absolutely. That's, they have DACA has a permission to work here, so they're gonna have income. Tax IDs, the problem is, they don't have any of that, but you know, everything else we can do.
So with the
Convention.
work permit, they also qualify for the FHA, right?
No, they cannot.
They cannot.
Oh, DACA, yes. Tax ID,
No.
no.
We did not.
Oh, DACA, yes.
A visa type, right?
Visa,
Yeah, so this is
yes.
eligible visa. types.
Yes,
Yeah, many
yes,
of them
so,
are
so those they can get, you know, like work permits,
Work permit.
you know, DACA is a type of work permit. So as long as you have a work permit, you can go both FHA and conventional, yes, yes, yes.
Employment authorization.
Yeah. That's what that is, yeah.
For minors, I think at the time.
I have a question about inspection.
Mhm.
The inspection is mandatory with FHA, nobody can quit.
So FHA does not ask for an inspection,
Really?
no.
Most of our loan programs don't require an inspection.
None of
or a
us, the
survey.
bank never wants to see an if we saw inspections, nobody will be getting a mortgage. Have you read those inspections?
It's scary.
They're scary, like home inspections are scary. You know, so we never want to see an inspection, ever, FHA or conventional. That is something the customer does to protect themselves, and usually the attorney is the one that, the attorney will always revise, you know, go over it with the customer. I never asked, I actually just, a customer just did an inspection, like I have the report, do you want me to, you know, what's your email? I'm like, do not, I don't wanna know what happened. at that
Inspections are
inspection.
done because people in New Jersey, sellers' disclosures are not required. So during an inspection, stuff would come up that
Yeah.
the sellers may or may not have
Okay,
disclosed.
so can you, one of you tell me if, the inspection goes over the price of, the question price, the owner has to go over, or if it's down the asking price, they have to go down?
Oh, you're asking about.
You're asking,
Appraisal?
no, you're asking about appraisal, no,
Appraisal.
appraisal's completely
Yeah.
different.
Sorry.
Yes, appraisal's completely different. Yes, so most loans do require an appraisal,
Yeah.
okay? Appraisal waivers, are we still getting appraisal waivers?
Yeah, all the time.
We are still getting appraisal waivers, but usually appraisal waivers, it's a very good customer, meaning 20% down. The prices, what that meant is electronically the system who comes in that area, like let's say it's a $600,000 house, that area is well priced for a 600,000, but 20% down, you know, like the whole deal needs to make sense for you to get appraisal waivers, they are happening. However, most of the time, we are gonna wanna see, you know, there is an appraisal to be done, and I feel like buyers wanna get an appraisal, right? Like, you know, you're gonna buy something and not know, I've had people that can waive them and have chosen to actually still do it, right? So,
Let me clarify, inspection, we don't require.
Mhm.
Survey, I said we don't require, and it's really not us requiring it, in most cases, we never need one, but the title insurance provider from your attorney is gonna need to have a survey endorsement.
Okay.
So they're gonna need to accept whatever survey is available, even if it's 80 years old. If it's too old for them to accept, then by definition, I guess we technically require them to get a survey endorsement, so we're gonna, in their estimation, they're gonna need a survey. And so we never tell you you have to get a survey, we never tell you you have to get an inspection, but an appraisal, in most cases, you need.
you might get it.
Very rare to get a waiver unless you have a large down payment.
Yeah.
And the property in question had a transaction in the last 7 years. In the last 8 to 10 years, if there was a mortgage got obtained on that property, it's very likely they have a data point. They connect that with their market appreciation data and they say, oh, you're good or you're not good
Yeah.
electronically.
Yeah.
But they don't do that for 10% damage. It's
Yeah. But I know you were asking about if it comes in less or more, right? So how does it work? Listen, The way it works is if it comes up higher, right, good for your customer, they bought the house with equity. If it comes up lower, right, the bank is only gonna lend you on the lowest of the two. So one of
The
two
attorneys
things.
take over
The
there.
bank will loan, based on appraisal price.
And
Yes,
so I'll give you two examples. One, we are buying $100,000 house and they're at the minimum down payment 3%. So the mortgage is 97. A house comes in appraising at 90,000. We're gonna lend them 90%, 97% of 90,000.
90,000, yeah.
That's called with extra money.
So if the customer has the money, no
Second
problem. You
example.
can do FHA, conventional,
Second example, they
anything.
have 20% down, they're getting $80,000 mortgage. House appraises at 90,000. We can change the mortgage to 10% down, they're gonna have to pay PMI, but they don't have to bring any extra money.
Mhm.
Or they can borrow 80% of 90,000.
Yeah.
Then bring more money.
Yeah, so,
Or the seller reduces the price.
yeah.
Yeah, we do that, and we
Yeah.
get seller
There's a lot of
credits.
But they need the middle,
Because
right?
that's a lot of
You know,
cases,
I'm gonna be
because if one
honest.
mortgage company comes in, you
Yeah.
already knew the rates lower, but the sellers were being not nice. Then a lot of times, this is the way the listing agent said, look, I told you your house was really worth this, you wanted this and got this, but now the mortgage is telling you this is what it is, you're not gonna get any more, you need to lower the price.
Yeah, and I know, you know, the last 2 years, right, you know, especially if you're a newer agent, you were seeing that people were buying houses and putting 100 over asking, getting care of it appraised. I got news for you. That's not happening anymore. So just like what Mike said, forget everything you did the last 2 years. Because that market's gone. You know, most customers nowadays are gonna have their attorney go back to the seller's attorney and they're gonna negotiate that price down. I see people even mid in the middle, right? If the buyer really, really wants the house and that's the house of their dreams, they'll make it happen, right? If they have, obviously, if they have the money, so.
Does the rule change if a person is interested in a foreclosed home? Or then what, like, can you get a FHA for a foreclosed home?
Absolutely, it's just, but the appraisal issues, right? So a foreclosed home, is the water gonna be running? Usually, so it all depends on the condition of the house, right? So the house condition will determine what product you go on, right? So if the water shut off, electricity shut off, you're gonna have to go rental. Because seller now, I mean, the bank, it's not putting water or heat on that house if it's already shut off, right? They're just gonna sell it as is. So you're not gonna be able to get CO, so you gotta go rental because we're gonna have to make the house livable again. So, you know, foreclosed house where the buyer, the actual seller was very cooperative with the bank. And they got into an agreement, yes, bank, go ahead and sell the house, everything's functional, it's a normal transaction, right? Because the house is functional, so it really all depends on that house.
Hi, Heidy, I'm
How
so
are you?
sorry.
It's okay, honey,
I'm
I'm
sorry.
gonna, it's recorded and we're gonna send to you,
Okay.
yes.
You finished all of them?
We did, but don't worry about it, I'll teach you on the side.
12 of them? I'm
11,
11,
11,
really?
yes, yeah,
Oh, I saw 12. Oh, my God.
yeah, no worries.
You're early for the next one.
That's what's good. And that's pretty much all I got for you
Yeah.
guys for FHA. You know, feel free, I moved my desk to the training room. So if you all have questions, find me there. When I'm not here, Mike's gonna be there. So, you know, we're here. Our cell phones are there, our emails are there, you know. We have a card.
Mike was quiet today, but he knows FHA very well.
Yeah, he does.
Just being a nice humble.
Yeah. So he's just shy, but he'll open up to you guys.
Yeah.
That's really good.
Thank you so much.
No problem. Thank you for
Anytime.
coming.
And then don't miss my next class.
When is it?
It's gonna be rental. I'm gonna put it on the calendar. So are you all on WhatsApp?
Yes.
Okay, I'll put it on WhatsApp. I'll put it on the email, but FHA rental, because I think that's also gonna
What
create,
is the difference, the FHA and rental?
because you can renovate the house. So you can get the money that you need to renovate the house and the money together, yeah, in one note. Yep.
You guys know about, like, let's say a client wants to meet up with
Is
somebody.
this much?
No, so we can do
Yeah, they have a
consultations
presentation
here,
coming.
so I'll
I
give
don't
an
know the date,
example.
I hear the microphone.
I think
Actually,
November 14th,
it's a
right?
newer agent in this office. Two customers of his, you know, they, yeah, from this, they couldn't do the application. I sent them the link. I met them, they live in Patterson, so I met them in Richwood, because that's more convenient for the customer than coming all the way to Rutherford, right? So, and I helped them do the application, everything in person, so we're always very accommodating, you know, and we have locations that we can meet your customers in any of our locations that's convenient for them,
Some wonderful person, I honestly had no idea who, was it us?
yes.
Oh, I didn't know that, bought you guys pizza, so you better hurry, because I'm gonna eat it all.
Thank you.
Anytime, I'm gonna give you my card. Oh, and I speak Spanish, in case you didn't know, hablo español, okay? And I try, and yo parla un poquito italiano. I try.
Thank you.
Right?
It's okay, we'll send it over, Heidi will send it in the WhatsApp.
I am so 120 days. Mike, I'm going to Turkey this
Okay.
And I am
Yeah, yeah, absolutely. No problem. Yeah, I'll be in this office. I'm in this office 4 days a week. The only day I'm not here is Tuesdays, but Heidi's here on Tuesdays. The only day I'm not here is Tuesdays, but Heidi's here on Tuesdays. You email me and I'll get it over to you. All right? Thank you. The FHA, the reno? Yeah, we're gonna do that also in November. I think it's November, Heidi. When's the Heidi? Okay. Heidi, November 14th is the reno, right?
I don't think I put a date on it.
Okay.
Yes, I didn't put a date, but you gotta come to my rental class. Oh, boyfriend should take you with. I love to go to